G'day and welcome to my video. My name is Kyle and I'm going to discuss an article that examines the competitive edge market makers gain by selling shares they do not own and have not borrowed. The channel Simulate and Trade recently discussed the article Failure is an Option, Impediments to Short Selling and Options Prices. I'm making this video to summarize and discuss some of the points made in that article. I'm interested in this topic because I suspect that shares I own in AMC and GME had been sold to me by a party that never had any shares to sell. I am not an expert in this subject area. My own area of expertise is completely unrelated. So I'm hesitant to expand on my own suspicions. Instead, I'm going to limit my discussion to the content of an article that is written by relevant experts. Please note that my lack of expertise in this area limits the reliability of my claims, even though they are grounded in the article that I'm discussing. After all, I'm stupid enough to make a video about a topic that I'm not an expert in, so I'm definitely stupid enough to get it wrong. I'll stress that again at the end of the video. Okay, so abusing short selling. Failure is an option. So a little bit about the article that I'll be discussing. In 2006, this article is submitted to the SEC, where it is hosted alongside many other comments received by the SEC. And there's a little picture here of what comes up if you Google it. You can see here just how many times it's been cited, and a little bit of information about it, and the link to where you'll find it on the SEC website. Now, in 2009, this article is published in the Review of Financial Studies, so several years after it was submitted to the SEC as a comment. And you can see here a link to where it's hosted as a publication of that journal. I'll have a link down in the description to the article, as you'll find it in its published version. So I want to note that Simulate and Trade's video, which encouraged me to make this one, or at least inspired me to make a video about this article that's mentioned there, describes this article as an official SEC document, so I'm not sure that's true. The article is hosted on the SEC website, but as a submitted comment. It is published by Oxford University Press in their journal, the Review of Financial Studies. So it has the hallmarks of a reliable article, but I don't think it's an official SEC document. This is not a crucial issue, merely a point I want to clarify, because the SEC website is host to other comments that vary in quality. Not all of the comments hosted on the SEC website have been published in relevant journals like this one has. So, what does the article say? Well, this is its abstract. I'm going to read through it here. You'll see that I've highlighted a couple of key points. The article says that regulations allow market makers to short sell without borrowing stock, and the transactions of a major options maker, market maker, show that in most hard-to-borrow situations, it chooses not to borrow and instead fails to deliver stock to its buyers. Some of the value of failing passes through to option prices. When failing is cheaper than borrowing, the relation between borrowing costs and option prices is significantly weaker. The remaining value is profit to the market maker, and its ability to profit despite the unusual competition between market makers appears to result from the cost advantage of larger market makers at failing. So the article explains that market makers can and do strategically fail to deliver stock to their buyers when doing so is cheaper than borrowing the stock would be. So they have the ability to do this, and they do use it to make money. That's what the article claims and shows. So this is a kind of shorting. This is what the article says when explaining that. Short sales are usually accomplished through equity loans. The short seller borrows shares from an equity lender, which he delivers to the buyer. This debt of shares to the lender gives him short exposure going forward. But there is another way to create the same exposure by failing to deliver the shares. if the short seller delivers nothing to the buyer, thereby incurring a debt of the shares to the buyer, this gives him a short exposure going forward. So, shorting can be a slippery term because it is used to describe specific practices but also refers to a general state of affairs. Broadly, shorting can refer to any transaction that results in one party owing another party shares. The owed party is short because the party that owes the share is short what they owe. So if they are short the share they owe you, they have a short position. They owe you a share. So intentionally failing to deliver a share is a form of shorting despite no borrowing taking place. Right? So it's a different mechanism of achieving the same exposure, being short a share. As the article explains, it is sometimes cheaper for market makers to short in this manner than it is for them to sell borrowed shares. It is also worth noting that the term naked shorting is difficult to pin down for similar reasons. Investopedia defines naked shorting as illegal, but it isn't quite that simple. Some practices that I would describe as clear examples of naked shorting are not illegal. Given the relevant regulations, their questionable enforcement, and the role of market makers, the practice of naked shorting and the term itself aren't so easily aligned. So when we accuse someone of naked shorting, there's a sense in which we're accusing them of something illegal. But when we use the term more broadly, well, that accusation might not match up with the terms that we're using. They might be naked shorting, but not doing anything they're not allowed to do. So the practice described here on the screen in front of us, that involves intentionally failing to deliver sold shares. So I think it is naked shorting. However, genuine market-making activities can involve doing the same thing, and this has special provisions in the relevant regulations to ensure it's possible. So, if the term naked shorting is intended to apply to only irresponsible and illegal activities, it isn't clear we can apply it to all cases we want intuitively to apply it to. So I think this is naked shorting, but the legal culpability that term might imply, well, that doesn't necessarily match up. So I'm going to use the term in a looser sense, right? I don't intend any legal accusations, of course. So the article goes on to describe why this form of shorting is good for the seller, but not the buyer. And in this case, of course, the buyer, I guess, being me. So it's good for the person selling me AMC and GME shares, but not for me, who's buying these AMC and GME shares that I suspect anyway have been shorted in some manner similar to this, probably without buying involved, or I should say possibly without buying involved. So it's good for the seller, not the buyer. Why? Well, traders are generally obligated to locate shares to borrow before shorting. But those engaged in bona fide hedging of market-making activity are exempt from this requirement. So unlike traders in general, a market maker can short sell without having to locate shares to borrow. If he does not locate shares to borrow, then he fails to deliver. Someone on the other side fails to receive and therefore retains the purchase price, and the clearing corporation starts taking margin. While at last, this arrangement is effectively an equity loan from the buyer to the seller at zero rebate. So until my shares are delivered, effectively I have loaned the money that I gave whoever sold me this share to them. And that counts as a loan because I don't have what I paid for yet. So they owe me something. I have loaned them the value in the meantime until they deliver. Now, this is a crucial point for my concerns because I am interested in AMC and GME. And furthermore, I suspect that a large number of those shares that are going through the market are being shorted in with a variety of methods, including loosely defined naked shorting. So notice that this form of shorting is described as a loan from the buyer to the seller. This is because the seller owes the buyer the shorted share. So in a sense, the buyer has loaned the seller the value of the share. Shorting is supposed to involve a loan between the lender of the shorted share and the borrower. But if no share is borrowed, because it's cheaper to simply fail to deliver, then the buyer effectively becomes the lender. In my case, as a buyer of AMC and GME, my shares would be loaned to whoever shorted it. Now, given that I do not approve of this form of shorting, I do not want to offer such a loan, especially to predatory shorting entities that I suspect are wreaking havoc on AMC and GME share prices. By the way, thanks to user Unloud from SuperStonk for the term predatory shorting entities. In my opinion, it's much better than the term we had been using, which was short hedge funds. Okay, so the article goes on to explain that shorting in this manner, the manner it describes, exposes the market maker, the one doing the shorting, to the risk of the buyer refusing the short and demanding delivery. Now, I find this noteworthy because it presents buyers as having a position of power that I do not believe myself to be in. I suspect that this is because my broker, in a relevant sense but not all senses, is the buyer of my shares. I don't have the power to demand delivery, but perhaps my broker does. So what I mean is that it would be my broker, not me, who would have to contest such a loan. So a loan like this has been issued on my behalf, because my share has not been delivered yet, but it's not me who gets to contest it. I have someone else acting for me. So when it comes to AMC and GME, perhaps the loan is better understood as being in between my broker and the shorter, right? So the article presents this type of loan as a loan between me and the short seller, but I think maybe not. Maybe my broker is standing there as the in-between instead. A recent due diligence post on SuperStonk argues that brokers' obligations to deliver the shares brought by their clients contributed to the price spike and buying halts in January. I'll link to this DD in the description actually, but I better stop that line of discussion, or I'll just never stop. Yeah. Okay, so here on the next slide is the key claim of this article. Naked shorting saves money. This is the focus of the article, and this is the point they're trying to establish and discuss. So they say, thus, the cost of failing to deliver is the cost of a zero rebate equity loan plus the expected incidence of buy-in costs. If this incidence is low enough, that is the incidence of people forcing the delivery, then failing is a valuable alternative to borrowing the harder to borrow stocks. We show that the alternative to fail is valuable and key to the pricing and trading of options. So what are they saying? They're saying failing to deliver saves money. So market makers fail to deliver. They have the power to do so because it is genuinely important for market making purposes. And using that power allows them to make more money on some of their short positions. So sometimes they fail to deliver. Simple, right? And a problem for their competitors who don't have this ability, right? Anyone else that wants to short these stocks, they can't do this. Well, they have to use the more expensive method of just borrowing the stock and then shorting it. So it's bad for them and it's bad for competition, but it's hardly the market-destroying issue we appear to be living through in AMC and GME, right? Just saving some money and being more competitive at offering options, well, there seems to be a lot more at play as far as what we're seeing with AMC and GME is concerned. Well, the article does outline the impact that this has. It points out that it's widespread, and it says, we can see the advantage directly in the market maker's shorting experience. Half the time the market maker shorts a hard to borrow stock, it fails to deliver at least some of the shares. And it never accepts a negative rebate, always choosing to fail instead. This advantage could in principle be offset by frequent buy-ins, but we find a very low frequency of buy-ins executed with small price concessions. So, yeah, the article is explaining that market makers do regularly do this. Furthermore, it's explaining that they do not undertake the practices that could offset the competitive advantage this form of shorting offers them. They do this, and there would be a way for them to offset the advantage they gain, but in practice, they don't. They just take the advantage. It's worth stressing that this is the point of the article, right? This article is examining the impact this form of shorting has on competition in the market. Specifically, the article argues that this practice gives a competitive advantage to large market makers who have the power to do this and the resources to implement it at the large scale. There's one more thing I want to say about the article itself before moving on to a brief discussion of the related academic literature, at least a couple of little snippets, and then finishing up. And that last thing is, it pays to be big, right? This is what the article says about that. How much of this advantage does the market maker share? Estimating the market maker's trading profits, net rebate reductions and buy-ins, we document a significant average profit. This profit seems at odds with the competitiveness of options markets, but we show that it corresponds to the way the clearing corporation handles buy-ins. The highest volume option makers, such as our Delta supplier, likely benefit from the clearing corporation's practice of assigning buy-ins to the oldest fails. That is, when a number of short sellers brokers are failing on the same stock and a buyer's broker demands shares, the clearing corporation passes this demand to the broker whose fail started first. This favors the few high-volume traders because since their portfolios turn over so much, their fails are rarely the oldest. Thus, we hypothesize that option market competition tends to tends towards a small number having a lot of control as stocks grow hard to short. So the bigger you are, the less it hurts you to short via failure to deliver. This hurts competition, but I don't think it's surprising. The article goes on to discuss how they test this hypothesis, using their data set which was obtained from a large market maker. This strategic form of naked shorting, using the term broadly remember, allows market makers to get a competitive advantage when shorting hard or expensive to borrow stock. However, the article does not establish that this practice is used for the kinds of predatory shorting practices I suspect are happening with AMC and GME. It's important to clarify that this article does not argue that these market makers are using their shorting privileges to bankrupt companies. Right? That's not what this article is arguing. I have a brief note on the wider literature, then a point to make about the limitations of this article. And after that, I'll finish with a note about another article that I think is important for understanding the threat of naked shorting. So, the wider context. This is what the paper itself says about the related literature. Well, this is some of what it says. This paper is not the first to document that shorting frictions associate with breakdowns of put-call parity. Limit and Thaler find that impediments to short selling prevent traders from exploiting seemingly profitable arbitrage strategies, resulting from the misalignment of stock prices and equity carve-outs. Similarly, Offek, Richardson, and Whitelaw measure the relationship between increased borrowing costs and put-call disparity, and find cumulative abnormal returns for arbitrage strategies involving put-call disparity exceed 65%. Okay. It's okay if we don't understand the specifics of the claims here. There are two key points that I'm interested in and want to share here. Firstly, this article is answering questions raised by earlier research. Right? This article isn't coming from nowhere. The article explains why some shorters are able to make money in situations where others are having difficulty doing so. The shorters that are able to make money in these situations are using their special powers granted for market-making purposes to gain a competitive advantage. This is important for us, important for my interest, because it reveals that there is an academic literature discussing practices related to what we appear to be seeing with AMC and GME. Secondly, look at the dates of these other articles. The relevance of this article and the related literature is limited by the changes in regulations, especially SHO. The data that this article works with has around 11 million observations after they've used their methodology to pare away those data points that they're not able to use for one reason or another. And those 11 million observations are from 1998 and 1999. So the article is presented as a submission to the SEC in 2006, and then it gets published in an academic journal in 2009. But the related literature is older than that again, and the data that they're using is from the late 90s. So, to an extent, the key claims of this article predate the current era of regulations that we're living in. So the specifics, their application is awkward. Now, I don't want to undersell how helpful this article is. It's important for us to know that market makers use their shorting privileges to gain a competitive advantage. Probably most of us don't find that surprising. In fact, it may even go without saying, but it's important for us to see studies establishing that this does happen. It's also important for us to know that they take these advantages even when, to a layman like myself, it seems unfair. So note that although the article is important, and it does serve those purposes, what the article can't do is prove that there is widespread naked shorting today. Okay. So I have just one more thing to say before I finish the video. They regulate themselves. So here, this book chapter, I've just got a little snippet here, a picture of its title. This book chapter outlines concerns that retail traders are being taken advantage of by institutions that utilize market mechanisms in ways not anticipated by lawmakers and regulators. It argues that an increasing amount of control is consolidating into a small number of hands. There is a 2013 article, which I haven't got a screenshot up, called Punishing Bad Brokers, that examines FINRA's regulatory actions and finds that the vast majority are resolved with fines suggested by the accused party. That's right, the vast majority of the regulatory actions undertaken by FINRA, according to this study, or this article, they are resolved by the regulatory agency agreeing that the party accused of bad play, fining what they themselves suggest they should be fined, paying what they themselves suggest they should be fined. So I should note that the suggested fines are in line with the recommended fines for the infractions in question, right? So they're not just pulling a number out of nowhere. They are saying, why don't you just let us pay the fine that we're supposed to pay, and that be the end of it. Well, sure, but problems with the process of determining these recommended fines makes that little comfort, right? Given the involvement these people that are being fined have in creating the recommended fine levels, well, that means that we're not that comforted by the fact that the fines they agree to pay, or the fines the regulators demand they pay based on the suggestion of the accused party. Well, we're not that happy with them just agreeing to pay the fine that they themselves played a role in determining. I'm going to stop there. I think this is another tangent that threatens to compromise the clarity and structure of my video, such as it is. So I'm mentioning these other pieces of work to point out that the claims being made by apes holding AMC and GME are discussed in the academic literature. These researchers are not arguing for the mother of all short squeezes, right? So there's not academic articles out there saying there's going to be the mother of all short squeezes, but there are discussions of claims and issues closely related to it. Okay, so important note, I want to stress, as I mentioned at the start of the video, that I'm not an expert on the topics that I have discussed in this video, right? My own area of expertise is far removed. I think this picture of a tinfoil hat illustrates that well. Everything I know, or think I know, about the US capital markets has been learned since February this year, right? So I'm no expert, I'm just a random guy who's fascinated by the topic and absolutely loving the crazy ride that I'm on. So thanks for watching my video. I'm not sure if I will make another. I have actually greatly enjoyed creating this one, so I guess it is likely that I will make another, perhaps on one of the two articles that I mentioned just at the end of the video there. Anyway, for that reason, please let me know what you think. If I do make more videos, which will focus on discussing more of the related academic literature, please, if I do make more, I would like to do a better job of it, and so feedback is appreciated. Thank you very much, and I enjoy my time chatting with all of you on Reddit.